Well, hello again, everyone. Welcome back to the Daily Gold podcast and the new series called Macro Mondays. Really excited for today, which is August 26th, 2024. It's a Monday. And with us is one of your favorites, one of my favorites. There's nobody better on macro when it comes to gold, Greg Weldon. And Greg, there's so many things I could ask you with regards to macro and how it impacts precious metals. And well, first of all, let's start off with the Fed, and then we get into the economy. It looks like the Fed's going to start cutting. What's the question here? Is it really, are they going to cut aggressively, or are they just going to kind of go by baby steps here? What do you think?
Right. Well, I like the macro Monday thing because what we have is madness and mayhem out there. So, you get the alliteration going. We can work Mondays quite a bit here. So, I would say that in terms of the Fed, I mean, it kind of is madness and mayhem. You go way back. We've had this conversation kind of since April of this year about the point where the Fed would be forced to basically change the narrative, the policy narrative, from fighting inflation to protecting growth. You need the growth to support all the debt, government debt, consumer debt. You see the delinquency rates on the rise to the degree that we haven't seen since 2007. This is a tell. The savings have been dwindled lower than it was in 2019. 6 trillion in savings at one point, now down around 850 billion. I mean, that's just massively wiped out savings. Even though inflation's come down, it's still around the level of wage growth. The Fed wants wage growth around 3.5% to 4% against the 2% inflation rate to give you, a 1.5% to 2% real wage growth, and you don't have it. It's flat. So the consumer is still hurting. We knew this, but the data really showed us this at an underground level. And what I mean by that is, for example, the retail sales data. You've been 13 out of the last 14 or 15 months. I forget exactly what the streak is now, because it's been so long that you have had real retail sales be negative to flat to negative. And there was a period of time there where the entire year-over-year growth in retail sales was, in dollar terms, was purely inflation. And the degree to which you had the discretionary sectors, clothing, furniture, everything except eating and drinking establishments and online sales were the two last bastions of some sorts of strength. Of course, the two key discretionary sectors where consumers will keep spending till like the last minute when they have to start really cutting back and going into a cocoon, because that's where we are, a consumer cocoon. And you've seen it now rise to the level where it's above ground and people see it. And this is particularly true in the labor market data. You and I have talked about this. I've been trashing this labor market data going back 6 months. Last 5 or 6 months, every single month, the household versus the government surveys, two totally different stories. And you have seen in the household survey, you get the degree of part-time jobs up 1.8 million over the last 12 months, full-time jobs down 1.5 million over the last 12 months. And that's before the revisions. So already you were in a negative dynamic in terms of full-time jobs, and now it's just, that much worse. Of course, the fact that, the government's lying to us now about everything. I mean, certainly beginning with the alien cover-ups, and then you led to the Vietnam War, and the government's lying to us, all these things, the FDA and covering up all these things, the Food and Drug Administration. I mean, the degree to which government lying has become just commonplace, where people now don't believe a thing the government tells us too. All this conspires to put the Fed in a difficult position. Why? Because inflation is not back to target. And while they now feel more confident that it will kind of drift back down towards 2, Jordan, and I know the second they refuel, inflation will hit a low and start to rise again. We've already seen it in some of the commodities. The deepest disinflation actually became deflation in food prices, which is now turning very dramatically in some of these food items. The weather is revamping. You've gone from El Nino to La Nina, and you see stuff like cocoa and coffee and orange juice are record price highs, right? So in that vein, the bottom line, I can take this whole long answer and really kind of mash it up into one thing. And I've been saying this all year long, that you would get to the point where the Fed was forced to acquiesce to higher general rates of inflation. And that's exactly where you are right now. They are now being forced by the labor market, which is clearly eroded, by the economy, by the yield curve moving into a steepening thing, which is one of our big themes for this year in terms of trades, and we're cleaning up in the Treasury market, is the dynamic around you have to protect growth, because you can't allow growth to not exist, because then you can't service the credit, and then you have a debt deflation, which is much more problematic for the Fed. They know it. I wrote my book in 2007. You know this very well. 2006, when I wrote the book Gold Trading Boot Camp. When peering into a deflationary abyss, central bankers will choose to reflate every time at any cost. And right now, the cost is going to be higher commodity prices, higher asset prices. And you start to go, because of our debt, into kind of this situation now where people have gotten so many people in this business, Jordan, really don't know what inflation is all about or didn't experience inflation. And in the case to which now you are in a 40-year downtrend that has reversed in a secular way to where you're only going to be getting more inflation, because the dollar is in play here. And you see it across a broad base of currencies. You can talk about the BRICS unit, which is huge. When you talk about which currencies in the world are appreciating most against the dollar, it's any currencies that's linked by trade, especially resource trade, to China. So the Fed is in a position where they had to shift. They not only that, but we got everything we really kind of what the market was demanding from the Fed, which is not just tell us you're going to shift policy, but telegraph a campaign of rate cuts to get to neutral. Because when inflation's at 2.5 on PCE and Fed funds is 5.5, that's a punitively restrictive policy stance you would expect when the economy was booming and well above par growth and becoming inflationary just from the growth. So that doesn't exist. They got to get to neutral, which the market is kind of deeming is around 3.5. So you asked, what's the big question? The big question, especially for the stock market, is what's priced in already. Is that enough to keep stocks going higher? And if it isn't, does that pose a risk to gold? Or does that actually cause something we haven't seen in a while, which is a massive rotation of capital within institutional equity money managers into precious metals? And I think that's where we're at right now.
Yeah, there's a couple follow-ups I have to that. So thinking about the economy, is there enough room for the Fed to cut rates where the economy can actually respond positively to that? And then the follow-up would be, how much fiscal stimmy are we going to see in the short term? Or I guess, over the next year or two.
Yeah, that's a great question. It's kind of the question, really, because number one, again, like it's already priced in for 3.5. All right. So what more do you need to do to get a reaction from the markets, number one, let alone the economy? And I have one of my themes this year is kind of a revamped old theme that I brought back, because a lot of the old themes are kind of coming back these days, it seems. But you remember in the 1960s, you may not remember, I'm old enough to remember, but when they say the 1960s anti-war rally was, what if they gave a war and nobody came? All right. So I've kind of twisted it. What if they gave, QE and nobody cared, and like it didn't work? And I think you're in that situation now where you have to stimulate so much because you need to generate credit growth at continually higher rates of growth to get the same dollar amount pumped into the economy. Because if you don't have that, the debt crushes you. So this is a real problem for the Fed. And this is one of my bigger fears, even for gold to some extent, because if it's a deflationary environment where all assets kind of come down like it did early 2000 or early in the sell-off in late 2008, that would be potentially a risk factor for gold right there. So I fear that that's a risk in that the Fed can't do enough. I was actually going through all the mortgage numbers this morning to try and determine how low would mortgage rates have to go to really start to be favorable to transactions in homes again. And you got to get below 5. And if you really want to juice, you got to get below 4. I don't know that that's going to happen anytime soon. And then you ask, well, they're cutting rates between now and the end of next year. They're not cutting up to 3.5 in September, right? So what is the interim, especially, and we'll learn a lot, Jordan, in the period between the September meeting and the next meeting, which isn't until the first week of November. So you got like 6 weeks there where this could be really telling. You get the rate cut everyone's wanted, but now what? We got 6 weeks where the economic numbers could be really bad, and that could shake up the stock market, and that could be then a risk to gold. So then to turn it around and talk about the fiscal side, the other issue here is the bond market and supply demand, because we know number 2 thing in the budget spending right now is interest on the debt. It's number 2. It's ahead of defense, healthcare, education. I mean, all of these things. You spend the most money outside of Social Security is on the debt itself. So that's not going to change. And the dynamic to which you have the curve steepening, because you have the short end coming down because the Fed will cut rates, but the long end potentially lags, and maybe, and I'm bullish on the long end in bonds for now, but I think there'll be a turning point when curve steepenings, because both sides of that are working, where the Fed is cutting rates, which is causing inflationary fears, number one. At the same time, you're talking about the fiscal situation where supply becomes onerous. And what are they going to do? They're going to QE it again. You know it. They're going to have to. And that's more public debt. That's more fiscal spending. That's more dollar downside. I think the biggest thing going on here right now is that this is a secular breakdown in the dollar that's finally matching the secular breakout in gold. And that to me is what makes this really exciting and even somewhat frightening, frankly, in terms of where the U.S. could go from here. But yeah, I think there's a lot in that question, and we could probably talk about for 2 more hours.
So I mean, whether we have a recession or not, I mean, I don't want to discuss all the possibilities, but it just seems to be like stagflation is the next.
Yes.
Really, that seems
100%.
And is it Greg, is it a question of, I mean, if we don't have a recession, then you're probably looking at stagflation really soon. If we do have a recession, then stagflation is just, a year or two further out. Is that fair to say?
Yeah. I would say stagflation is on the horizon. Yes. I think the recession, I mean, you can make a case the recession started in May, or really, well, yeah, June with the May data. I mean, because you really saw the labor market and the consumer really come off hard. The housing market come off hard. I mean, let's not forget the housing market. I mean, you're going to try and cut rates here to stimulate the economy. You need the housing market in play. It's far from being in play, let alone the fact that most mortgages are much lower than the current, mortgage rate is. But let's, also talk about the fact that you have starts and permits violating trend lines going back to 2009 lows. You got existing home sales broke a 59-year uptrend line recently. So when you have housing completions also, and building, like the new homes that they're building that they're selling before they're built now, those sales are way down. So you see the dynamic around the sales decline, which has boosted inventories. There's a huge increase in existing home sales for sale. The problem is that's all because of lower sales, not because you're building more homes. The point here is you're going to have another massive round of inflation in housing, which is not really accounted for in some of these forecasts. That's going to further crimp the consumer. So this is another issue that we're not even really talking about. But I think that that's where you talk about stagflation. It really is, because you're in this mode now. You're talking about price controls and stuff. We're not even getting into the fact that you have an election coming up where half the country is going to be rioting, the other half celebrating. And you have all kinds of situations where this could lead to major social unrest. And in the meantime, if people are out rioting, they're not in the stores buying stuff. So that's going to hurt the economy. So there's so many of these landmines out there now, that the Fed would potentially be pushed to be more aggressive, which in turn drives the dollar down, drives gold up. So I think while there's risk here to this whole scenario, the probabilities have really swung since I kind of peg it to May and June. But obviously in the last couple of weeks, I mean, the July meeting, what Powell said was very specific. Markets got all excited, then they came all the way back, and he really set the stage here with his comments at Jackson Hole. When he says there's bigger risk in the labor market than inflation, that was as clear as you could make it. And he's right, no doubt. I mean, so again, but inflation is not a target, and inflation has signs of moving higher. And what if you get, I mean, to me, this is like the Chinese are really happy with this whole scenario, because if you have a problem in the Middle East, particularly right ahead of the election, which you could certainly see being the scenario that plays out, oil prices spike and China drops the dollar card, and we're facing a real tough situation economically here in the U.S. So I don't think it happens that quickly, but it really could, and that's the risk.
All right, let's talk about markets a little bit. When are we going to see gold and commodities outperform the stock market? Because I know you follow all these ratios like I do. Gold against the S&P, I wrote that like it's been the bane of my existence. I mean, gold looks great in nominal terms. A beautiful cup and handle breakout. It's trending. And then you look at gold against the S&P, and it's like I'm looking at it, I'm like, holy shit, this thing, gold could get to 3,000, and this chart can still look like a turd, basically.
Yeah. Well, that's why you want to look at the ratio, because I actually did a big study on the U.S. stock market, I mean, maybe a week ago. And we did a week ago, let me see, a week ago today, I did a big piece on the metals, right? And I followed that up with a big piece today on the metals and all the mining shares. So any of your listeners and viewers can certainly get that if they email me. But at the same time, about 2 weeks ago, I did a major big piece on the U.S. stock market. And it was kind of, interesting in that context when you start to talk about, what is the kind of, you could see that a dollar decline is bullish for stocks. I mean, it's the most tight correlation we have of any two markets is foreign exchange currency against the stock market. Look anywhere where the currency is getting smoked. Argentina, Turkey, Pakistan, Angola. I mean, all these places where the stock market is making new highs because the currency is down. But the stock market doesn't keep pace with the debasement of the purchasing power of the currency. So that's where I think the U.S. is kind of at. So I could see a scenario where stocks go into a melt-up phase here, where you have the dollar down and gold and stocks go up together. But at the same time, you're in a scenario where I think gold does begin to outperform. You're seeing some rumblings there. You're seeing, for example, the GDX start to break out against the price of gold. That's a tell right there. One of the things we talked about in the last show that wasn't happening, and I said when you start to see this happening, it will be a tell as it relates to the stock market, is the big three for me, big cap blue chip behemoth stocks, benchmarks really, Anglo Gold, Ashanti, Barrick, and Newmont. When they start to perform, that will be the next phase of exuberance because they've underperformed. It's been upside down where the smaller stocks have been the leaders in this wave of gold price rally, and the majors have really, not done well, and that's flip-flop now. And I think that tells us two things. Number one, that the gold in the ground, that these companies have incurred debt, maybe why they've underperformed, to buy up these companies that are unable to produce the gold profitably. It's gold in the ground they're buying, and they can produce it profitably. And at some point, that becomes much more valuable. And I think that just happened. And number two is back to the stock market, because the institutional money managers, the public, very much underinvested in these markets. I mean, even if you look at the speculators in gold, the open interest is not high at all. And in fact, it comes down anytime you get a $20 sell-off. People don't believe in this gold rally. A little bit more they are now, but man, it has been a climbing the wall of worry to some extent. But the point here is when you see the Newmonts and the Barracks breaking out, that's a sign that you're starting to get what is the biggest picture move that we could want to see here, which is rotation of capital by institutional investors, by passive index investors in the stock market who own no precious metals, to move into precious metals. And they will do it by buying the names they know, the Barracks, the Anglos, the Newmonts. And you're seeing that because they're picking up the torch of leadership. So I think there's a lot of tells there that suggest that your period of frustration may be coming to a close. But I don't think it's going to be one of these things where, gold goes up and stocks go down and you have this gigantic divergence. I think it's quite the opposite, where they kind of are tied together. Gold just outperforms. But I will tell you this too. And within the stock market piece that I did a couple weeks ago, my point in mentioning that is very simple. One of the charts, phenomenal chart, compares the Dow divided by gold against the Dow. And ever since 2000, and then especially since 2009, they are so much different charts. And if you talk about what is the purchasing power of the Dow, it's basically unchanged for the last 15 years. So that's something to consider too, that investors don't really look at in terms of which one is really protecting your ability to buy stuff better. And frankly, right now it's kind of, it's been flattish, and there's been certainly times when gold hasn't been the better performer, but I think that time is pretty much over.
Yeah, Greg. One follow-up on what you're saying, and then also maybe a question. I think what you're saying is so important about the fact that there's so little money in the precious metals trade, even in precious metals itself. And then you look at the stocks. I mean, for me, that's why I'm not worried about a 2008 boogeyman. Like there's so, everyone has a recency bias in precious metals. All the questions I get, seems like literally everyone is worried, like, okay, when's 2008 coming?
Yeah.
But in 2007, precious metals were going up for 6 or 7 years. Like the money that was in the trade at that time was huge compared to now, where it just sounds like it's just getting started. So I don't want to say gold can never go down, but
right.
That's
I
just
agree
my
with
view
you.
right now. I don't. I mean, I know that it's possible they could get pulled down if the stock market has a big drop, but I'm just, because of what you said, I'm just really not worried about that at this point.
I agree with you. I mean, you always have to point out the risk, and the risk is that scenario. But I think the risk is way smaller. I 100% agree with what you just said. This is much different in that sense than it was in 2007 and 8. Way different because people are not invested here, and because they see the bigger picture. They understand the debt. I get people, I'm in Palm Beach, Florida, and I got people that are really successful with way more money than I am, right? But they're very successful in their own fields, and they don't do what I do. And they'll come to me and they'll ask me, what should I do? Should I take some protection? Should I buy some gold? I mean, it's the question. It's kind of an ongoing question the last 2-3 years. But as this intensifies, and what's interesting about it is these people are extremely smart, extremely successful, but they just don't know the markets that well. And they're a little afraid because they're so used to being passively invested in stocks. And of course, the second you mention this to a global wealth manager at one of the big brokerage houses, they're like, no, you can't invest in something besides me and our stock market program. But the point here is you can tell they're asking because they feel something's not right. There's like a disruption in the force, if you will. And this is the fact that you have so much debt. The government lies. The government spends money on everything. It's gotten so irresponsible. I mean, I just continue to point out the February budget numbers from this year. The government spent twice as much money as they spent twice as much money as they took in. That's completely irresponsible. And when you look at the deficit, when you look at the debt that we have, exponentially higher, people feel like they've kind of lost control of this. And to whatever degree, they feel their money is less safe. So I think that makes a big difference from 2009 when the system was at risk and everyone was freaking out. And eventually they did end up buying gold anyway. I think this is different where it will be a more immediate reaction. You will have that rotation. It will be bigger and broader than anything we've ever seen. And these are the kind of things that when I used to work at Prudential with John Fallon on the bullion desk at Pru, and man, they were big time players back then. And we used to sit around. I mean, we're talking, mid 1990s and discuss a scenario where, people want to put 5 to 10% of their money into gold and how insanely wild that could be because these markets aren't that deep, man. And if you got that, even a 5% in an average portfolio in all these brokerage houses, you'd be looking at gold at $5,000 an ounce.
No, easy. Probably higher than that, but that's just me. And the other thing, Greg, is when these people want to invest in gold and the other people you're talking about, the advisors, isn't it just like, oh, well, you can put 3% in gold or like 5% in gold? That doesn't do anything. That doesn't make any difference.
Yeah. No, it doesn't. And I mean, you could make a case, and it's a hard case to sell to a lot of people that, you should have 100% in gold because the dollar is such at risk here, let alone we're not even talking about the Chinese/BRICS story, which has picked up steam this year like you would not have expected. If there's any surprises for 2024, it's how quickly, how organized, and how real this BRICS currency is. It's huge. It's a giant risk to the dollar, and it's right in front of us right now. So I think that it makes a big difference in my mind to think that, the train is leaving the station. And I also think that when you talk about this, and I've been saying this now for a better part of 3 months, that you will have investors chasing this market higher because they don't either own gold or they feel like they don't own enough because this is your protection. And now is the time to protect. Because why? What makes this difference? 40-year secular reversal in the trend in inflation. Case closed. Very simple.
Right. Okay. Just a couple more for you, but along the same lines. Do people in your world and the people you talk to that you mentioned, do they ever mention gold stocks? Because just a side note here, because I'm really pounding the table on Twitter about this. You look at gold stocks, fundamentals are improving, costs have stabilized. I mean, you're a technician like I mean, the charts of a lot of these stocks, they're looking really good. GDX is close to a major breakout. And even smart people on Twitter, they're talking about just buy gold, don't buy the gold stocks. I mean, to me, Greg, that just seems like perfect sentiment. Everybody knows that gold stocks suck. Like everybody knows it. I mean, nobody mentions that, gold, precious metals were in a secular bear for a decade. But everybody knows gold stocks suck. But for me, that just seems like it's a perfect scenario, given the fundamentals and given that they're trending up. People hate it, but it's trending up now. I mean, Anything you can add to that?
Yeah, absolutely. I mean, first of all, I would say, well, everyone's an expert on Twitter, so you don't need to, have experts anymore because everyone is one. All right, so take that with a grain of salt. All right, doing this for 40 years, you definitely don't stick around this long without providing some value added. But what the value added I would add here is twofold. All right, number one, right off the bat, I would say that two things. First, I mean, the professional money manager out there, okay, the guy who is running, a family office, the guy who is running, retirement accounts or all these things, I think that versus gold, they would prefer to buy the shares. I mean, so that's kind of number one. I think it's the animal they know. And I think that they feel that it would have a better return because it does tend to outperform, right? The GDX, you kind of look like, especially the SIL and silver. I mean, you're coming off levels you saw in 2015. I mean, gold and silver don't get this cheap relative to the broader market very often, and it's cheap, downright cheap, right? So that's interesting. Let alone that the SIL is dirt cheap against the GDX too. So you have this whole dynamic too. But I would also say, let's look at it a little different way, because what you have here is kind of a new paradigm for investing in gold stocks, and that is very simply, you are so far above the average cost of production now, like we haven't seen. You got $1,000 margins now, which, and so this is really, you're looking at second quarter earnings that are like, posting records and these kinds of things where you really have value. Can you imagine the metal stocks as a value play? I mean, that's kind of intriguing thought process, right? So I think all of these things bode well for the metal shares. And frankly, if you look at it, we do a metals letter, gold and crypto letter called the Gold Guru Report, right? And in that, we use our quantitative tools where we rank the top shares. And I'm telling you, the top shares are up, 70, 80% over the last 52 weeks. There is some huge performance going on out there in some of these metals. You pick the right metal shares, they have skyrocketed. I mean, there's several that are at new all-time highs, not only just the 2011 highs, new all-time highs. So the opportunities are there. It's kind of a stock pickers thing right now. And I think that continues, which kind of, it makes it valuable to do some homework, because there are many of these individual shares that have far outperformed bullion in this case. And I think that will become more broad-based. So yes, I think, again, it's one of those things, a little more patience. You come into the zone now with these mining shares become much more valuable as the price goes up, because now it's pure profit margin from here on out. So yeah, I do like the mining shares. I think, for me, it's a blend. It's kind of like the mining shares. You always have a portfolio. You can use the futures market is what we do to ramp up the leverage like we are right now. And then passive investors can always, buy the GLD or the, GDX. But I think having a little bit of everything is just a much better way to go, because you're kind of never sure which is going to get the big blast, which is going to be the favorite of the month. And then somebody asked me, would you rather own gold or silver? And I'm like, KISS, keep it simple, stupid. Own both.
Both, yeah.
Really, take the problem out, take the question out of the equation. There's no need to ask that question. Just own both.
Okay, one more thing. Is there an intermarket relationship or a ratio that you're looking at to signal that we're starting to see money really move into hard assets versus the stock market?
Yeah, I mean, I look at all the ratios. So certainly the CRB is to look at one. We haven't really even talked about energy, which, you have supplies near a 5-year low in terms of crude oil. You're actually taking down a lot of crude oil to pump out gasoline, where your supplies are actually, pretty decent on a year-to-year, 2-year basis. So I think that when you start to talk about where are the inflation risks, I think that energy has been dismissed as one when it is a major one, because this Middle East situation keeps intensifying, and yet the market is so just complacent about it. I mean, it's a laissez-faire attitude. Like nobody really cares, I feel, in terms of the market until something pops off. And by then, you know how the markets are now. I mean, they react, they reprice, and then they move sideways for a couple of weeks. So my kind of thought process around this would be that you have some kind of inflationary episode in the energy shares that really messes up the whole thing here. So, I think that that's something to watch, just that. But I am watching the CRB index. It came down. It did a nice Fibonacci. It held levels it needed to hold. Then looking at the DBA, the Dog Boy Alpha, which is the agricultural commodities ETF, to me, that is critical going forward because you're going to have food issues going forward. And that's going to be an inflationary item unto itself. So you look at food, energy is a big risk on the upside. Food is already kind of turning and has a lot of individual commodities. So I think for me, just watching those things against the stock market, and of course, then just watching the mining share index ETFs against the stock market as a ratio play. It's really just kind of almost that simple. And then watching the dollar, because that really, again, will be key. When you see the dollar, it's already off 5% from its high. It is a massive long-term picture. This is so important to me, is the dollar and then the dollar's value relative to gold. So when you want to measure the purchasing power of the U.S. currency, divide the dollar index by gold. The dollar index is a little flawed because it's not trade weighted. It's more European currencies, but so what? Who cares? You know what it is, so you use it as it is. And in that case, I think when you see gold is flirting with the 2011 dollar low, when the dollar hasn't even broken down much from 100 yet, is huge in telling you how much downside risk is in the dollar here and how that would boost commodities, which then might be a thing where, that would be a problem for stocks because you're hurting margins for certain companies and these kinds of things. And that's when you start to see the ratios move out and you start to see the commodity sector outperform the stock market. I think that you're maybe one, if not two steps away from that. At first, I could see kind of a run up in everything into the next Fed meeting. They cut, stocks kind of come down, it stalls the move in gold. Then maybe at some point it boosts gold. And then you go into a run where everything's going up and gold's just going up faster.
Okay, I forgot to ask you about this earlier. I know you were talking about 2,700 gold. I think that was your target. And do you have any new targets for gold and silver that you can share?
Sure, I do. 2650 had been our original target for this year at the beginning of the year. And, you're pretty much there already. 2570 was the high in the December contract right now. Silver, you get through 3250, you're going to 40 very quickly. And I've been saying more recently, and you know me, I don't like to make outrageous claims just to make headlines or whatever. Not that anyone's making headlines out of our conversations, but you know what I'm saying. And it's like, well, I could easily say $50 silver, and it could happen fast. And I've been saying, it's not a question of whether you get to $50 in silver, and certainly it's not a question of whether you get to $40 in silver. It's a question of how fast does it happen. And I think you're kind of in that mode. So my upside target for gold now has changed a lot because the BRICS unit dynamic has changed everything. You take the amount of dollar assets selling that could happen here just based on this. Take the Brazilian Central Bank, for example. Their reserves, 80% are dollar. They want to be in the BRICS unit. They got to dump those reserves, at least half of them, if not all of them. So you're talking about, hundreds of billions of dollars of sales. And this is where the bond market comes back in play, the yield curve come back in play, and how all of this translates into gold. What are they going to do? They're going to buy gold with those dollars. And then not only that, they want to hold the gold in-house in their own countries, right? Because that's part of how this BRICS unit is being formulated and crafted. They've already got the mechanism in Russia that will clear all these things. It's going to be blockchain based, but you could actually, because it's blockchain based, each currency could be part of it based on who you're trading with. So in other words, if you're China and you're trading with Brazil, it would be one basket. You're China, you're trading with Russia, it's a different basket, all right, including gold backed by both of those currencies held by those countries. So this is why all these countries want their gold back, right? So that's a whole nother problem for some of these bullion banks. If all of a sudden everyone wants to take delivery on gold and silver, you could see some real fireworks in these markets. Based on all of that, I have like a new 3-year projection, which I don't normally do, but really it's all math. It's all math based. And it points you to 49.45 over the next 3 years in gold. Silver, I could easily say $100 silver. If you want to start talking about, okay, well, silver's at 30, could never go to 100. All right. Cocoa was at $3,000 a ton, and in the space of a couple months, it went to 12,000. All right. So anything is possible in this day and age with the amount of money that's been printed and fueling all these things. So for me, longer term, it's not outrageous to suggest, and you know me. I mean, a couple of years ago, you would never use these kinds of numbers because you'd be considered a gold bug kind of nut job, right? Not anymore, because these numbers are not unrealistic. In some kind of medium-term time frame of 4,900 in gold and $100 an ounce for silver. Let's
Wow.
not forget
Well,
Bitcoin and Ethereum either. Let's not forget crypto either, because if you're in a lot of countries around the world where it's like the one thing I used to do back in the 90s, we caught some huge moves being short some of the Asian tiger currencies, Malaysian ringgit, the Thai baht we caught. I mean, these were massive trades, man. And it was all about what I called the competitive currency devaluation raceway. If you take pre-1971, okay, all the currencies are in it like it's a NASCAR or Formula One race where they're racing around Indy, for example, right? So gold was the pace car. The pace car was out in front, and all the cars ran around where they're supposed to be lined up in the grid, right? Well, 1971, you took the pace car off the track and let these cars run wild, all right? And we've seen crashes, we've seen currencies that taken out of the race and killed and whole 9 yards. Well, that kind of went away. NASCAR hasn't been as popular as it used to be back in the early 2000s. But frankly, this is the kind of thing that's coming back. So if you're in a country like Brazil or say Turkey or even Pakistan or some of the African countries, Angola is a major oil producer, for example, their currency's gotten annihilated. And gold in that currency is up by so much, it's not even funny. But it's a lot easier for people around the world to have a digital wallet, a phone, and to buy crypto than to buy and hold physical gold or silver. So that's why I'm not an anti-crypto guy. Do I think that Bitcoin someday may be worthless? Yeah, I do. But I think in the meantime, it could go a lot higher and people can make a lot of money in these things, because that's what we want. We want things that move, and we'll pretty much trade just about anything that offers us the opportunity to make some money for our customers.
okay, that's a great segue, Greg, because I want to have you tell our listeners where they can go to find more information. I know sometimes you're kind enough to give our audience a free sample or report of your research. So tell our listeners where they can go to subscribe, and also about the work you do.
Yeah. Well, we do 3 different newsletters, for lack of a better phrase. The Gold Guru. We do the Global Macro Strategy Report. It's more of an institutional type of product. It's global, it's futures, it's everything. When we do every bond, stocks, energy, metals, agriculture, commodities. And that's, it also has individual investors who do it themselves, find it specific recommendations with stop loss levels and very, disciplined risk controls overlaid. And then we have the Portfolio Playbook, which is a U.S. stock-based product with different model portfolios for different types of investors, but also trying to help the average guy level the playing field to become his own hedge fund, to become his own CTA, where you can use the ETFs and currencies and foreign bond markets and foreign stocks and commodities, for example, and even stuff like the GDX and the GLD and the SLV, SIL, to have a stock market portfolio that protects you from some of what's coming next in terms of dollar debasement, including owning a dollar down ETF, for example, had been as part of our one little allocation in our discretionary portfolio. So the Gold Guru, the Global Macro Strategy Report, and the Portfolio Playbook are the 3 research products. There's videos and daily PDFs. You can email me at sales@weldononline.com. WELDON online.com, one word, or Greg Weldon at weldononline.com, either one. And we'll get you some information on that. We're also operate a CTA, registered, Series 3, managed money for individuals. And that's the best way that we can help people, is because I can be much more nimble, much more flexible, much more in and out, much more precise with the risk management, doing it myself for people. It's a high minimum, but we are actually right now, it's not always the case, but right now we're open for new investment from accredited investors. So also Greg Weldon at weldononline.com. You can check me out on Twitter at Weldon Live. We do the podcast, the Money, Markets, and New Age Investing podcast, which is on Twitter at money_podcast. And then find me. You can see some free videos sometimes on YouTube. It's a Gregory_Weldon on the YouTube channel.
All righty, Greg. Thanks so much for coming on. Really appreciate it. Love the work that you do, and hope we can talk again maybe around the end of the year, see how things are developing.
Sure, it's going to be an interesting 3 or 4 months, so it would be my pleasure. So, and you do a great job, Jordan. So kudos to you as well.